Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research. I'm speaking to you at the end of 2018. There is some concern about a slowing world economy in 2019, and also related to that, anxiety that monetary policy may become ineffective. Interest rates have been very low to zero and can't go down anymore. And there have been suggestions that increasing the quantity of money, as in quantitative easing, may fail to boost the economy in quite the way that it did back in 2008 and 2009. What I want to argue in today's presentation is that monetary policy can never be ineffective, and that many of these claims that the effectiveness of quantitative easing declined as more and more doses of QE were injected into the economy, that claim is wrong. I'm going to be using the quantity theory of money. Let's just remember that. Starts off with the idea that MV equals PT, the quantity of money times the times it goes round, the velocity, is equal to the value of all transactions, which is the price of things multiplied by the number of such transactions. Now, this is a truism, but there are quite a few things that I have to say about it. If the velocity of circulation is constant, then it's clear that a change of X% in the quantity of money is associated with a change of X% in PT, the value of transactions. And it doesn't matter whether it's a 10% change of money or 100% or 1000%. If V is constant, that effect comes through. Now, this proposition is a very powerful proposition. It's known technically as the proportionality hypothesis. And however, there's an ambiguity. Should we be talking about the value of all transactions or national income? And in practice, many of these discussions are about the relationship between money and national income, and the velocity of circulation is actually the desired ratio of money to income, related to that. The question then is, when you look at the facts of the real world, is it true that when the quantity of money rises by X%, we actually see a roughly X% change in national income? And I want now just to refer to my notes to make sure I get this right. We're looking today very much at American data, the world's most important economy, and you can see here that we've got the numbers on money and GDP for the USA going back to 1960. Period of 57 years in which the average annual growth rate of broad money, quantity of money, was 7.4%, and the increase in nominal GDP was 6.5%. And then if you look at the sub-periods, there is a relationship, not a brilliant one, but a relationship between rapid monetary growth and rapid growth of national income, and slow growth of money and slow growth of national income. And in fact, the last few years have seen rather slow growth of money and very low growth of normal GDP by the standards of that almost 60-year period. Now, there's an awful lot more to say, but I would say that this gives us some basis for thinking that the theory is correct. You might just qualify that bit by saying that money grows a bit faster than national income when wealth is going up, because wealth rises faster than income, and then there are transactions related to that, and the banking system increases a little more than other activities as people become richer, and so on. But if you just take what Milton Friedman said with Anna Schwartz back in 1982, was that the idea of a constant velocity is an impressive first approximation. You can debate and discuss that, and I think it's fair to say it's a reasonable starting point, but anyway. And what is true, surely, is that the changes in velocity are small compared with the changes in national income and spending transactions. Now, what does that message then mean for the effectiveness of monetary policy? In this long run of data, and velocity isn't constant, but it doesn't change that much, so not much compared with changes in money and national income, then I would say that it is true, roughly speaking, that if the quantity of money is changed by government action by, say, X%, then you'd expect 2 or 3 years later national income to be X% higher, more or less, than it otherwise had been. If there is a big recession, the ability of government, if a government is able to do this, the ability of government to add money into the economy is a weapon, it's a nuclear weapon. It is the most powerful imaginable weapon to stop a recession. And it ought always to work. Now, you're going to ask, how is it the quantity of money is increased by government action? It's incredibly simple. The quantity of money is increased if I go to my bank manager, and my bank manager says, Tim, here's a loan of £100,000. We had £100,000 to a deposit, which is money, and that's on the liability side of the balance sheet. We had £100,000 on the asset side of the balance sheet, that's a loan. You spend your £100,000, but you've got to repay that loan at some future point. Okay. That's how money is created, in essence. I'm not as creditworthy as the government. All the government has to do is to go to the banking system and say, we want a loan of, take an argument, £200 billion. At the moment, in Britain, money supply is about £2,000 billion. So the effect of the government going to the banking system saying, we want this loan of £200 billion, same process, £200 billion on the asset side, loan from the banks to the government, £200 billion on the liability side, that's government deposit. Government spends that deposit, spends it on anything from you, me, the non-bank private sector public. That increases the deposits to the non-bank private sector public. That is money. The quantity of money rises 10% like that, and it's as simple as that. Okay. Sure enough, there's discussions about whether the 10% jump in money is due to a budget deficit or due to open market operations, QE, which, look, the government can always do this. The message of that just explained how large increases over long periods of time, quantity of money, quantity of national income. Government can create money. If the government creates new money to the tune of 50% of money, then 2-3 years later, perhaps sooner, perhaps a little bit longer, national income will be 50% higher than it otherwise would have been. That's implied by the proportionality hypothesis, which actually fits the facts. QE can never be ineffective. Monetary policy can never be ineffective. Now, the question then is, why is it that there's any confusion about this subject? And the answer is that economics is in a terrible mess about this subject. There's a press conference in 2014 when the chairman of the Federal Reserve, Ben Bernanke, said that QE is a process of creating money to boost national income, or boost macroeconomic outcomes in some sense. This QE works in practice but not in theory. Well, it depends what kind of theory you believe in, and perhaps Professor Bernanke and I don't believe in the same kind of theories, but anyway, the trouble I think comes from this view that monetary policy is defined by the level of the rate of interest, or the change in the rate of interest, or some rate of interest, whether it's the central bank rate or the bond yield or something, and by people who then look only at the rate of interest and not at the quantity of money. There's an article in the current issue of the Journal of Economic Perspectives by a chap called Kenneth Kuttner, where he talks about the effectiveness of QE. Unconventional monetary policy is another phrase he uses. And he says that over time, the different dosages of QE that were applied to the American economy between 2008 and 2014 became less effective. He says that because they had less effect on the 10-year Treasury bond yield. It's as if the 10-year Treasury bond yield is the factotum, the be-all and end-all of monetary policy. I'm going to just explain in a few minutes where this obsession with interest rates comes from, but what I want to say now is that actually this is all nonsense. I should just, before I go any further, just say that the journal in which Professor Congdon has given this article, is a good journal because it tries to make itself readable. Far too many academic journals are unreadable, and they're supposed to be clever because they're difficult to understand. No, the Journal of Economic Perspectives is a good journal. It tries to make itself easy to follow, and that's why I want to focus on Professor Congdon's thesis. Let's be clear that there are many types of asset in a modern economy. Yes, there are bonds issued by governments and companies, and there are also equities. There's quoted equity and there's unquoted equity, and some unquoted equity in small businesses that, that people got equity in pubs and shops and law firms and all sorts of things, okay? People also own real estate. They own real estate and equities and bonds in their own country and other countries. Bonds are only a small part of portfolios. When we try to think about how economies behave, we mustn't think just about the effect of monetary policy on the bond yield. We must think about the effect of the quantity of money on spending, incomes, output, on wealth, and all these things must be brought into some kind of equilibrium with each other. Bonds are only part of the story. If the velocity of circulation between money and income is stable, and there's also a stable relationship between income and wealth, must follow, logically, there's a link between money and wealth, meaning money and not just bond yields, the returns on equities, the returns on real estate. Okay. Let's now again look at the American economy and get a sense of how important bond yields are relative to other macroeconomic prices and variables. This is a pie chart of composition of American household wealth at the end of 2016, still pretty much up to date, and at that date the bond share in all this, you can just see it's that green bit, was 4%. Alright? 96% of household wealth was in other assets. Why are economists so obsessed about bond yields? Bonds are tiny relative to other assets. The way of thinking about this is to look at the changes in the value of household wealth over the years and to see to what extent changes in the value of bonds are part of the whole picture. What I've done here is to compare changes in the value of people's bond portfolios with changes in the value of their equities and real estate. Equities and real estate are the red bit, and the yellow bit is the bond portfolios. You can barely see the bond portfolios. Again, why are we so obsessed about bond yields? All right? Much, much more important are movements in the prices of equities and real estate. I sometimes get accused of being Rip Van Winkle in all of this because thinking about the quantity theory is so old-fashioned. I don't really care. The question isn't really whether one's being modern and up-to-date. The question is whether one's being right. And anybody can see from this chart that bond yields are not the whole story of the impact of changing the quantity of money, due perhaps to government action, due perhaps to QE. They're not, the changes in bond yields are not the whole story. Let's remember the proportionality hypothesis. 10% change quantity of money implies 10% change in equilibrium national income, changes over a few years, and also 10% change in equilibrium value of national wealth, meaning predominantly value of equities and real estate. That's a kind of hypothesis I'm putting to you. Let's now again look at the facts. At the end of 2016, American household income was, in 2016, was $14 trillion, $14,000 billion. Household net worth was getting on for $92 trillion, multiple of 6.55. And money holdings were about a bit over $11 trillion. The ratio of money to income was 80%, and the money to net worth just over 12%. Okay. Now, if what I've been saying is correct, you'd expect these kind of numbers, this sort of 6.5, these sort of ratios of money to income wealth, to apply over the long run, over decades. Okay? Let's look at the facts. This shows you the ratio of household net worth to as a percent of disposable income going back to 1946, period of 70 years. Household net worth's gone up 104 times, household income almost 85 times. The ratio has changed, but not very much. Let's look at the ratio of money to household net worth. Now, to remember, household net worth's gone up, was it, I'd say 104 times, was it? 104 times. And the ratio of money assets to household net worth in the USA today is more or less exactly what it was in 1945, 46, the end of the Second World War. Almost exactly. Gone up and down a bit. Now look, I put it to you, the proportionality hypothesis is correct. Look, I'm aware there are lots of caveats, problems, qualifications. I know that. And then let's just look at the facts. This is 1946 to 2016. Personal disposable income, compounded increase 6.5%. Net worth 6.9%. Money holdings 6.7%. In other words, if the QE causes the quantity of money to rise by 10% in 2010, then the effect on economic national income is 10% over the next 3, 4 years, 5 years, when it's cleaned out. Another 10% in 2012, same effect. Another 10% in 2014, same effect. There is no reduction in the effectiveness of changes in the quantity of money. It will always be true that changes in the quantity of money boost national income by roughly the same amount. Always. That's implied, in fact, by basic theory, whatever Professor Bernanke thinks about the matter. Where is this rubbish about bond yields and interest rates and so on? Where does it come from? It comes, in fact, I'm afraid, from Keynes's general theory of 1936, where he had a theory of the determination of the rate of interest, which did depend on the quantity of money, but there's this case he proposed in which people worried that the price of bonds might collapse if they bought any more. So the government increases the quantity of money. People are so afraid, investors are so afraid that bond yields might rise and the price of bonds fall, that the effect of increasing the quantity of money isn't to push the interest rate, the bond yield down. And this idea was called by a chap called Dennis Robertson, was called the liquidity trap. And we hear endlessly about the liquidity trap. And Dennis Robertson also pointed out that this theory worked only if the one choice that investors could make was between money and bonds. He mocked it as a college bursar's theory of the rate of interest. Because, of course, college bursars in those days chose having money in the bank or in government securities, in bonds. In practice, investors are choosing between money, bonds to some extent, and equities, and real estate, commercial property overseas, commercial property at home. They're choosing between a whole range of assets, and bonds is just a tiny part of it. As soon as we allow for that, the liquidity trap simply is a laughable idea. It cannot possibly have the effects that Keynes thought it might have, and frankly Keynes should never propose something so silly. Let it be said here that movements in the value of bond portfolios are always very small relative to movements in other asset prices, the price of our asset classes. And it sometimes is the case that the price of bonds moves in the opposite direction from the price of equities and real estate. This happened in 2008 and 2009. Fears of deflation, bond yields came down, bond prices rose. At the same time, the equity market and real estate were being hammered. Movements in bond yields are not the key to the movements of asset markets in general. A much more sensible view is that we have in equities pay dividends. Dividends are part of national income. They move roughly with national income. So the effect of a 10% increase in the quantity of money is to raise the equilibrium value of equities, roughly speaking, by about 10%. Rents are part of national income. They increase with national income. They go down with national income. When the quantity of money rises by 10%, roughly speaking, the value of houses, the value of property goes up and down by 10%. Look, I know that's the difficulty of these propositions. I know they are. But basically, that's a good starting point for thinking about the subject. With bonds, it's much, much more complicated. There is no mechanical relationship between an increase in the rate of growth of quantity of money, which is going to push up inflation, or an increase in the level of quantity of money, which may cause... Bonds is an awkward asset. It's a blasted nuisance they should have ever been brought into this discussion. It's much simpler, much more realistic to say that when money goes up by X%, the equivalent value of national income, the dominant asset classes, also rises by X%. And that is the real world. Okay, so finishing on this topic now. When the quantity of money rises by 10%, then the equilibrium value of reasonable starting hypothesis, reasonable way of thinking about the subject, is that national income and output also rise in equilibrium terms by about 10%. So does national wealth. And so we come back to transactions. Because of course transactions are partly in current goods and services that go into national income and output, and partly in financial assets, other assets as well. So money is important to all three of these categories, all these ways of thinking about the economy. Let me conclude. Monetary policy can never be exhausted. In a way, something like Venezuela today, or Weimar Germany, with hyperinflation, shows you that if there's a relationship between money and inflation, there's a relationship between money and national income, and proportionality hypothesis is a good way of starting to think about the subject. Economists' obsession with the effect of monetary policy on bond yields, it all goes back to Keynes, is misleading and dangerous. Bond yields are not a good guide to asset yields in general. It's quite possible for bond yields to rise when the yields on equities and real estate go down, vice versa, and the effect of movements in the value of bond portfolios is always tiny relative to what's happening to the value of houses and equity portfolios. And finally, I wish economists would stop talking about the stupid idea of liquidity trap. Liquidity trap will never be found in a real world where assets are not just bonds, but equities and real estate as well. The liquidity trap is the Loch Ness monster of economics. Thank you.